This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set for gains at the Monday open, led by Japan. A stronger than expected US jobs data has bond traders buckling for a no-landing scenario. Chinese officials set to outline the delivery of economic reforms tomorrow. It's a potential boost for investors as mainland markets reopen. And Hon Hai reports faster revenue growth as AI server demand offsets weak smartphone sales. We're live in Taipei.
And Heidi, of course, will be watching U.S. inflation data this week, expected to moderate. More important because, of course, we got the jobs payrolls numbers last week, and really jobs growth in the U.S. continuing at the fastest pace in 6 months, even the unemployment rate unexpectedly falling. We had Treasury yields then rising and really seeing that market reaction. Only 24 basis points of easing now factored in for the month of November at this point.
Yeah, and Shery, we are just getting news from the European Central Bank, and at least the Governing Council member François Villeroy de Gallau saying that the ECB will quite probably cut rates at its next meeting later this month. And remember, inflation did fall below that 2% target in September. That core measure of price increases should gradually recede close to the level in 2025. This is according to the Bank of France chief in an interview with La Repubblica. He also said that market expectations for inflation for next year are below 1.8%, so even lower than the ECB's forecast. And all of this, he says, means that the balance of risks is shifting. In the last 2 years, our main risk was overshooting that 2% target, and now they're having to pay attention to the opposite risk of undershooting the objective due to weak growth and restrictive monetary policy for too long. So it's interesting because Villeroy has been quite quiet on ECB policy in recent weeks, as these expectations have really kind of shifted from a near zero to almost certain at that October 17th decision. And immediately after that reduction of rates in September, he did say that policymakers should continue with that gradual approach. So we'll continue to watch sort of the impact in particular when it comes to trading in the euro. We're also watching, of course, for further developments when it comes to these ongoing conflicts in the Middle East, right? Israel, as we continue to await for that reprisal against Iran. In the meantime, ramping up these operations in Gaza as well as Lebanon before that one-year anniversary of the October 7th attack. And we have heard from the vice presidential candidate Kamala Harris and Vice President Kamala Harris, I should say, saying that she will not stop pressuring Israel to end its military campaign in the Middle East. I guess putting emphasis on this sort of a doubt in terms of how much influence Washington continues to have across the region.
We'll continue to watch oil-related stocks in the Asian session. This is a setup right now. We have the Japanese yen continuing to weaken for a fourth consecutive session. We're near 2-month lows against the U.S. dollar at around that 149 level at the moment. We had some upside for Nikkei stocks in the previous 2 sessions. We're seeing upside in the future space as well. We do have a couple of important central bank decisions, including the Bank of Korea and the Central Bank of New Zealand as well, expected to cut rates this week. Right now, we have the offshore yuan not doing much. Of course, we do have the mainland markets away on holidays. The Australian market is also away on holiday today. They're coming back tomorrow. But take a look at the setup in the U.S. markets as well, because we had gains in the previous session, especially when it came to Treasury yields surging on that stronger than expected jobs report. So we had the 10-year break-even rate and those expectations also now at a 2-month high, as we're expecting U.S. CPI and PPI numbers this week as well. But of course, we do have earnings season at the same time. JP Morgan expected to kick those off this week. We're watching crude prices at the moment. Brent downside of 0.6%, but we'll see trading in WTI prices as well, Heidi.
Shery, let's get more on that reaction to the jobs data, right? I'll bring in our Bloomberg Executive Editor for Asian Markets, Paul Dobson, who joins us now from Singapore. And Paul, it really does seem like with almost every data point from the US, it continues to confound this idea of expectations for, enough of a slowdown, enough economic weakness to warrant another jumbo-sized move from the Fed.
Absolutely right. That's what we saw in all of the data pretty much last week with the economic surprise index. The Citigroup uses to track that kind of thing, pushing into positive territory as well. So people, really less worried about that slowing of growth in the US, and the jobs numbers were really the sort of last thing to confirm that. So what it did for interest rate pricing for the rest of the year is cause traders to really pull back those bets on a second 50 basis point cut for November or for December for that matter as well. Now pricing in just less than 25 basis points for November and just more than 50 basis points for the year. So people really pulling away from that idea that the Fed is going to continue with aggressive cuts just because it doesn't need to. The economy seems pretty comfortable going along with this elevated level of interest rates. So the Fed can cut nice and easily and gently, doesn't need to be too aggressive, doesn't need to worry too much about that, does need to keep half an eye on inflation again. So we get those numbers this week that all of a sudden, a little bit back in people's attention just to check that that doesn't show anything that's surprisingly too strong.
Yeah, we went from really that hard landing scenario and fears that we could see a crash and a recession in the U.S. to now it seems sort of a no landing scenario. What does this mean for the Treasury space?
I think that it's a little bit of a dangerous thing. I mean, we saw a big pullback already in the bond market on Friday. People had those bets on for a re-steepening of the yield curve, lower 2-year yields relative to 10-year yields. That's really pivoted quite a lot as well. We're close to flat again between the two of them. So those short-term interest rates in particular getting pushed higher again. But also the back end of the yield curve not faring very well. And I was looking at the year-to-date returns for the US Treasuries this morning, and we're back to, just a little bit around 2%, something like that, a bit more maybe. So not very impressive. When you look on the other side of the calculus, the gains that we've seen for equities, for example, still looking like a more attractive place for a lot of investors to want to park their money, so long as we have continuing robustness in the economy, so long as the earnings season isn't a disappointment.
Bloomberg's Paul Dobson there with what to expect in the markets. And this, of course, as we're marking a year since the October 7th attacks by Hamas. Israel is locked into a multi-front war with no clear end. Prime Minister Benjamin Netanyahu is still weighing how to respond to Iran, which launched a salvo of almost 200 ballistic missiles at the Jewish state last week. President Biden has sought to discourage Israel from attacking Iran's oil fields as the U.S. works to keep the Middle East region from descending into all-out war.
The Israelis have not concluded what they're going to do in terms of a strike. That's under discussion. I think if I were in their shoes, I'd be thinking about other alternatives than striking oil fields.
Let's bring in Bloomberg News editor Ian Fisher for the latest. And of course, Ian, we continue to watch the stance coming from the U.S. and its relationship with Israel at the moment. In a time when we're headed towards the U.S. elections in November, how much diplomatic push does Washington still have?
I don't think it's got a lot of push at all. I think, Israeli Prime Minister Benjamin Netanyahu has sort of repeatedly ignored the advice of Joe Biden. Kamala Harris seems to be promising or suggesting a somewhat tougher line. Today she was talking about how she's going to continue to push for ceasefire. Until recently, the ceasefire discussions were centered on Gaza. There's not a lot more to bomb in Gaza, honestly. And she was talking about Lebanon, which obviously over the last 2 weeks is very much ramped up. And now we're in a moment of extremely high stakes waiting as Iran decides how it's going to retaliate against those 200 missiles that Iran sent into Israel last week.
Do we see any movements or any hints of Israel's response? Of course, there's been a lot of sort of talking down in terms of some of the options that would, of course, create a lot more volatility across oil markets, for example, or even the talk about potentially striking those nuclear facilities.
Yeah, the answer is on the ground, absolutely nothing that we know of. Tonight, Israeli officials met with the U.S. head of Central Command, Michael Kurilla, who went over to Israel to discuss what the options were. Israeli Defense Minister Yoav Gallant today repeated the Israeli position that all options were open, so that does mean oil fields. It, in theory, although it would be quite a move of consequence, the nuclear sites, possibly, one expert thinks that that we quoted in one of our stories that Israel's almost certain to hit one nuclear site, at least to sort of show what it is that they're capable of, and that they could do more. But anyway, to answer your question, it certainly will come soon, today or tomorrow, depending where you are in the world. Marks 1 year since October 7th and the death of 1,200 Israelis at the hands of Hamas, in southern Israel. There's no indication that at the moment, that there's going to be some sort of, that they'll move on that date, as some sort of symbolic move. But, one never knows. It could really come at any time.
Bloomberg News editor Ian Fisher there. Coming up on the Asia Trade, Vanguard Group tells us why they think the latest US CPI print will allow the Fed to cut either 25 or 50 basis points. Plus, we'll ask M&G Investments on why they see recent dislocations in Japan and India as opportunities. This is Bloomberg.
Enough talk about inflation is dead. Inflation is not dead. Enough talk about the Fed should only be concerned about maximum employment. It should still be concerned about its dual mandate.
This is, across the board, a very strong report. If you look in the under components, retail, professional services, education and health services, all significantly beat above their 3-month running average.
I think the Fed should still go another couple of 25s. And then I still think they should go next year. And I don't think you're going to create any instigant for more inflation here. I just think the rate's still too high.
We've been saying slowing but not crashing. And I think certainly the markets and the Fed were very focused on potential downside risks as a result of the weaker labor market reports.
Some of our guests are weighing the Fed's next move after the stronger than expected U.S. jobs report. Now, here's a look at the week ahead. We'll be keeping an eye on the latest inflation data out of the U.S. Bloomberg Economics expects the CPI print to show inflation moving closer to the Fed's 2% target. Minutes during policymakers' most recent meeting will also reveal the consensus behind the Fed's jumbo 50 basis point cut last month. Here in Asia, rate decisions from New Zealand, India, and South Korea will be in focus. Consensus sees a half-point cut from the RBNZ, a 25 basis point cut from the BOK, and a hold from the RBI. On the earnings front, big banks will start to report their results, with JP Morgan and Wells Fargo leading the pack on Friday. JP Morgan could reveal robust top line, while Wells Fargo may suffer the biggest net interest income decline among its peers. Samsung earnings are also due after Bloomberg reported that it's planning to cut thousands of workers in Southeast Asia, Australia, and New Zealand. And that's your week ahead.
Let's bring in Wang, who's the Chief Asia-Pacific Economist at Vanguard Group. Really great to have you with us. And it is a lot to focus on, particularly with China rejoining the fray after the long holiday. But I did want to start off with still sort of processing just the latest in the string of US data, right? Do you think it's too early to say that the Fed will now only be focused on the labour market side of its mandate?
When we are looking at the dual mandate, clearly, I think, the Fed has recalibrated its reaction function and trying to focus more on the labor market side, right? But I would say it's probably too early to say that they completely ignore the inflation side, especially, given the positive surprise on the September labor market report. I think it will be closely watched to see whether the strength in the job growth as well as the wage growth will translate to service inflation, right, which can be very sticky. So I think this is where the market rhetoric has clearly shifted away from the recession fear. This is where also they expect less Fed cuts, right, in the near term. I think this is very much consistent with the Fed's message that there is absolutely no rush to cut. So even if we still expect the Fed to cut 25 basis points in November and December, we think that is more like to normalize monetary policy rather than, in the urgency to save the labor market.
There's a lot more urgency when it comes to Chinese policymakers, right? As probably demonstrated by the barrage of mostly monetary policy-focused stimulus that we had before the National Day holiday. As they come back online, we're also expecting this National Development and Reform Commission meeting. Do you have expectations from the NDRC tomorrow?
Right. I mean, I think in terms of stimulus supporting the economy, right, I do see there are several stages when they push out the supporting measure. Now, the first stage you already seen before the national holiday, a holiday that is really focused on the sentiment as well as the liquidity support. That really generates the rally in stock market. But the second stage is really what they are going to do to revive the demand in the economy. And that is where I think all the eyes are actually on the fiscal policy, right? So I think, down the road, I mean, the NDRC press conference, as well as, probably later in October, what the National People's Congress, they are likely to approve more supplementary fiscal package, right? So that, I think, is going to be in the focus for the market to see what they can do to support the consumption as well as the overall economic growth.
How much of what they've already announced actually reflects and addresses some of the structural issues that China faces?
This is where I don't think cyclical policy is going to address or fix the structural problem, right? Cyclical policy really just buy time for the policymaker to address those root issues, right? So you could actually provide a temporary boost to the housing market or the equity market, or actually the economic growth in the next 1 or 2 quarters. But none of that, I think, will be sustainable unless the government really address the fundamental issue. I think the root issue I see 2 here. One is this structural downturn in the property sector, right? So far, a lot of the housing support measure was focusing on the demand side, but a significant issue is really about the oversupply. So unless the central government is willing to leverage its balance sheet to ensure housing delivery and also for the housing buyback, I don't really see the housing market to stabilize in a sustainable manner. The second issue, I think, is really about the consumption, right? Consumption, I think the most important thing is really about the income and job prospect. And that, I think, really depends on the business confidence and animal spirit, especially in the private sector. So I think government has to tackle with that as well.
It's so interesting to see the deep contrast when it comes to the Chinese housing market versus, say, in the other economies like New Zealand and South Korea, where you're seeing these signs of overheating. We do have their central bank decisions expected to cut rates this week. Given how cautious the Fed is, given the risks around geopolitics and oil prices, what will these central banks have to really keep in mind moving forward the rest of the year?
Always saying that Asian central bank, their rate cut cycle is going to be slower and also narrower than the Fed, right? And now with the potential oil price increase, with Fed actually, going to slow down the pace of their cut, and also with the U.S. election coming, I would say for many of the central bank in the region, they probably will be more cautious, especially for those who are concerned about financial stability, right? So RBI I think they are likely to remain on hold this week. I don't think they are going to start their easing cycle until later this year or even early 2025. For Bank of Korea, I think, yes, we do think they are going to start a cut, right? Especially when you see that inflation is coming down below 2%. But I think the governor is likely to send out a hawkish message, emphasizing on their financial stability, mandate. And even for RBNZ, I know the debate at this moment is really about 25 base point or 50 base point. But I would say, the sentiment seems to be stabilizing, consumption also stabilizing. So in that case, I would say probably RBNZ will also err on the 25 base point cut side.
Wang, good to have you with us. Chief Asia-Pacific economist at Vanguard Group, of course, as we head towards a busy day of a lot of central bank decisions across Asia. We have more ahead on the Asia trade. This is Bloomberg. China's economic planner will host a news conference tomorrow to discuss the implementation of incremental economic policies. This comes as the world-beating rally in Chinese stocks is failing to convince some global fund managers and strategists. For more, let's bring in our China correspondent, Mingmin Lo. And Mingmin, of course, we've had so many false dawns when it comes to the Chinese market. So what can we really expect from the National Development and Reform Commission meeting that we are expecting tomorrow?
Yeah, all eyes will be glued to the screens tomorrow at 10 a.m. That's when the National Development Reform Commission will be briefing reporters about a package of incremental economic policies that they will be rolling out. So we don't have a lot of details yet, but obviously we'll be looking out for what sort of policies there will be to boost demand, to support private sector growth and investment, to support employment and income and social security as well. We also want to look out for how much supply side versus demand side policy there would be. And of course, there's a lot of expectation riding on this, right? Especially after that Politburo meeting last week that really set up expectations that the government is really putting its whole weight to try to steer this economy back on track. And some analysts are expecting that tomorrow, as mainland China markets reopen after that 1 week Golden Week holiday, they're expecting a big jump in mainland China stocks in a catch-up rally there. But of course, if expectations fail to, if the meeting tomorrow fails to live up to expectations, that could dampen sentiment a little bit. And already we're seeing a lot of skepticism coming from some global equity fund managers who are skeptical about how long-lived this current rally would be, especially if the fiscal stimulus don't follow through. We may also hear from the NDRC about what sort of projects that they may be prioritizing for the usage of local government special bonds, for instance, because while the Ministry of Finance is the department that issues those bonds, the NDRC is the one that approves the projects that they can be used for.
The other major development, of course, is this EU vote to impose up to 45% tariffs on Chinese EVs. What do we expect to happen next?
Yes, so the tariffs have finally came through. It is going to come into force starting from November for 5 years. And we have seen, for instance, the CEO of Volkswagen saying that, he is fearing that China could retaliate. And that would affect those German car makers, right? They could be significantly disadvantaged when they sell cars in China, for instance. And he is calling for some exemptions for certain companies that, for example, invest in opening up plants in Europe. And there are several companies looking at that already, BYD, for instance, and Shery looking to open up plants in Europe. And that could be the next stage of this tariff war, whether the EU will start to scrutinize some of these plants and how much local content there would be in Europe.
Mingmin Lo there with the latest. This is Bloomberg. Let's get your morning calls ahead of the Asia trading day. And billionaire investor Stanley Druckenmiller is concerned that the Fed has boxed itself into a corner when it comes to future rate cuts. Druckenmiller hopes that the Fed is not trapped by forward guidance the way they were in 2021. He explains that growth is above trend, corporate profits are strong and stocks are at an all-time high and credit is very tight. Druckenmiller's comments were built on warnings by other Wall Street figures that markets need to temper expectations about the pace and extent of the Fed's easing. Meanwhile, for Wall Street veteran Ed Yardeni, the Fed may hold off on rate cuts for the rest of the year following the strong jobs report. The founder of Yardeni Research says further policy easing would risk of sparking inflation just as oil prices rebound and China seeks to jumpstart its economy. He's adding that the central bank's September decision to lower rates by half a percentage point was, quote, not necessary, Shery.
And Haidi, Bloomberg Opinion Columnist Mohamed El-Erian also thinking that the latest U.S. jobs reading means expectations for Fed rate cuts are overly aggressive. The Queen's College Cambridge president told us what he sees as the key priorities for markets and the Fed from here.
So thanks, John. 4 takeaways, including for the Fed. One, on the labor market. This is not just a solid labor market, but if you take these numbers at face value, it's a strong labor market late in the cycle. 2, for the economy, it speaks to U.S. economic exceptionalism, something we've seen and something that's continuing. 3, for the Fed, it means push back much harder against pressure from the markets to put you in the single mandate box. Enough talk about inflation is dead. Inflation is not dead. Enough talk about the Fed should only be concerned about maximum employment. It should still be concerned about its dual mandate. And finally, for the markets, I think this is pushing back against what has been, in my view, and you've heard me say it over and over again, an overly aggressive expectation of rate cuts by the Fed. I think this will get the market closer to what's likely. And then we're going to have a debate on 2 things. One is, where's the neutral rate? And 2 is, how do you think about this economy in terms of growth and employment, and how are these 2 things coming together? So, at face value, this is a report that will cause a lot of revision, both in analysis and in market pricing. But I stress it is part of a much bigger picture of mixed data. And that's where the complications arise, John, as you know.
Mohamed, Emory nailed it when she started saying, how much does this have to do with the 50 basis point rate cut? And it's somewhat tongue-in-cheek, of course, but at the same time, there is a real question. How much have the easier financial conditions that have basically been manufactured by this Federal Reserve helped boost a market that wasn't maybe in need of such a big boost?
Look, my view, we've been living in a world of liquidity dominance. It has been all about liquidity. That world was reinforced by a 50 basis points cut. Let's also remember that the market didn't expect a 50 basis point cut based on data. It expected it based on a reporting on the Thursday before the Fed board meeting. So there was no economic conditions that would justify 50 basis points, but there was a leak to a newspaper that moved market expectations. I worry that we continue to feed this monster of liquidity dominance, and at some point we may regret it, either because inflation will not settle at 2% and or because financial instability will result from excessive risk-taking.
Bloomberg Opinion's Mohamed El-Erian there speaking with our colleague Lisa Abramowitz, of course, as this debate over where the Fed heads from here and how they view that dual mandate, and are they really kind of, really not disregarding but certainly prioritising more the jobs aspect of that mandate. Take a look at how we're setting up when it comes to the start of the trading week here in Asia, though. There is that RBN decision to watch, and really quite interesting in terms of how litmus test is going to play out for how Asian central banks move, given some of the uncertainty over the Fed's path. The shadow board for the RBN said certainly is divided over what size this week's cut should be. That's according to the New Zealand Institute of Economic Research. Members recommended a 50 basis point cut. They were concerned about the continued weakness and excess capacity in the economy, but then there were others that, viewed that 25 basis point cut as being more appropriate for now. Shery, for the rest of the markets, we are seeing a bit of upside as we see the start of trading in Japan and also US futures looking pretty muted.
Yeah, investors also will be watching, of course, the earnings season. We are getting some of those results, especially this week from Fast Retailing and 7&I, which could show how Japanese retailers are chasing growth overseas to make up for a lagging local consumer sector. Let's bring in Bloomberg's Rena Sasaki. And Rena, really, there were expectations that with wage growth, people would go out and spend. But what are we expecting to see from retailers' earnings?
Yes, so the Fast Retailing and 7-Eleven are reporting on Thursday this week, and we are expecting Fast Retailing to grow steadily of about 25% of operating income, thanks to the overseas, the Uniqlo overseas that accounts for about 70% of its overall revenue. And the heightened demand of it's a summer collection of aerialism for the hot temperature bolstered the stronger than expected sales.
Oh, I like those. I've tried them.
Yes. So the bolstered the sales in North America, Europe, and ex-Japan and China, Asian market. So in China, the revenue growth has been slowed and then trailed the other markets. However, the company is aiming to grow in the Greater China by opening up the 80 store annually and strengthen the e-commerce segment.
Yeah, interesting that everything that you mentioned is ex-Japan, right? What are we seeing in terms of some of the other reports we're expecting out of Asia? For example, South Korea, we have Samsung, LG Energy as well.
Yes. So Samsung will show how it's faring in the space of artificial intelligence. And the report last week about the announcement of the mass layoff of 10% of overseas employee worries investors. But we're expected to see the growth in operating income for the Samsung, thanks to the high average selling price of the memory chips used in artificial intelligence applications, as well as the new foldable phone that's in the market.
Bloomberg's Rena Sasaki here with the latest on those earnings out of Asia. And Heidi, we'll be watching, of course, 7&I's potential restructuring as well this week that might, in a way, overshadow some of those results. We are hearing from sources that given the approach from Couche-Tard, we could see 7&I vying for some changes in terms of disposing of some of their assets.
Yeah, that story continues to get ever more intriguing, right? But speaking of big earnings stories that we're following, Shery, the Taiwanese industry giant Hon Hai reported over the weekend. Of course, this is a company best known for assembling iPhones. Major focus here, though, were developments in AI. Let's get more from our tech reporter, Annabelle Jewellers, who's in Taipei for us. And there's one theme that investors care about, but let's take a look at the numbers. What jumped out to you?
Well, yeah, one thing that investors care about, but of course not every single company can back it up to the same extent. But Hon Hai is really doing well in this space, and the category they're doing well in is AI servers in particular. So they're taking the NVIDIA chips made by TSMC, putting them on a main board, assembling that into a rack, and then that's sent off to hyperscalers, the likes of Amazon, Alphabet, Microsoft, big ones that are using it for their AI cloud businesses. So Hon Hai is really gaining market share in this category in particular. It really perhaps assisted their latest earnings as well, because we saw sales rising around 20%. So they came in for the third quarter period at around $60 billion US. That was past analyst expectations. And the company as well said back in August that they do expect AI servers to contribute to growth into the end of the year. Our Bloomberg intelligence team as well saying it could go into 2025.
Belle, how about the electronics component of the business?
This has been a really interesting one to watch. And of course, Hon Hai or Foxconn is known as the world's biggest assembler of iPhones. They're not just making iPhones. There's many other products they're assembling. Sony PlayStation, Nintendo Switch, the Kindle, Google's Pixel phones, for instance. But the iPhones is really the key one. And what we've seen so far are the early indications that sales of the iPhone 16 haven't been quite as strong as perhaps had been tipped, perhaps given that the AI part or component component of that phone as well has sort of undershot market expectations. We don't have the revenue breakdown for the third quarter, but in the second quarter, and if you look back beyond that, you can see that the components category of its revenue is decreasing over time. Hon Hai in this category is losing out market share to the Chinese iPhone assembler Luxshare in particular. But again, given that focus on AI in particular, the AI server category, it is sort of cushioning that impact because Hon Hai is saying these third quarter numbers are a record for the period.
We're also seeing the annual Tech Day this week as well, and of course Bloomberg will be there. What are we anticipating?
This is going to be a really major event. We're actually at the conference venue yesterday where this is going to be taking place, and Hon Hai is really billing it as their biggest one yet. This is the 50th anniversary of the company, so of course there's quite a lot of expectations around that. But this one in particular is going to be the first one ever to be open to the public, so it just really tells you that level of public interest in the company as well. But we've got some big interviews coming up from the day that includes with Hon Hai's head of EVs. We didn't get to that in this segment, but Hon Hai is making a play into EV contract manufacturing as well. Question marks over how well that will play out into the future, but we do have a really great interview coming up with Jun Seki, who leads that division, so one to watch, as we said. Hon Hai Tech Day starting Tuesday this week.
Abel Jewelers there in Taipei, a lot ahead when it comes to the tech space this week, but more ahead also on the Asia trade. This is Bloomberg.
We're headed towards the Japanese market open. Take a look at how we're setting up. Of course, we continue to see the downside pressure on the Japanese yen against the U.S. dollar. We're at around 2-month lows right now at around that 149 level. And Nikkei futures pointing to the upside of more than 3% at the moment after already 2 sessions of gains. We'll be watching those exporters to see if we see that upside when it comes to optimism about Japanese equity markets. All of this as we got Japan's Prime Minister Shigeru Ishiba instructing his cabinet on Friday to draw up a package of economic measures in a show of support to inflation-hit voters ahead of a general election.
I will make sure deflation is defeated, protect Japan's economy and create its future. We'll create a growth economy led by wage gains and investment, while also seeking to improve Japan's fiscal health. Japan's economy and finances should strongly develop and be crisis resistant.
Let's bring in our next guest who thinks Japan's real wage growth and financial tax issues seem to be a concern for risk assets. With us now is Shoki Omori, Chief Japan Desk Strategist at Mizuho Securities. Shoki, great to have you with us. Before we were coming on air, you were saying there is so much to discuss at this point when it comes to the Japanese markets. What are your priorities in trying to gauge where the markets go from here?
First of all, thank you for having me. And of course, we have a lot to talk about today. And Nikkei futures are up 3%. So I guess it's going to be a bull market today. And going ahead, there's nothing to stop the bull market from going on because of the Fed, BOJ, and some stimulus from the government itself.
What are your expectations for the yen? We're almost at 150 already.
I see 150 in the near term, 155. But then there might be some intervention from the Minister of Finance, first verbally and then actual intervention. But at the same time, investors might see there might be no intervention because of the election coming up.
The general elections on October 27th here in Japan.
Yes.
And of course, we have the U.S. elections coming up in November as well. It's a busy season when it comes to political changes. But I do wonder, when it comes to the finance ministry and liking certain levels of the Japanese yen, how much is it about levels and how much is it about the pace of the change?
I think it's about the speed. We were at 143 last week, and now it's almost 150. And I think this is just going too fast for the Minister of Finance. And I don't think they will like this. Because if the carry traders, the CTAs come on again and test 160, I mean, who is going to stop that? That's going to be a question for the BOJ and the Minister of Finance.
Shoki, there's also been renewed momentum when it comes to Chinese risk assets, right? Do you think that there's been a meaningful shifting of global portfolios, and perhaps that has been to the detriment of some outflows from markets like Japan?
I mean, I think so. I mean, last week, I think we saw that flow from Japan to the Chinese markets, but as we see now, Nikkei futures up 3% in Singapore. I do see some meaningful inflow into Japan again as well.
There is a sense that maybe some of the sort of low-hanging fruit has already been peaked for Japan, right? What sectors do you see as being kind of the next ones to look for? And certainly we've seen oil, for example, benefiting. Do you think there's further upside for the energy sector?
Yes, that's obviously not my thing because I'm on rates and FX. But generally speaking, that will be exporters. That will gain, and that will be the trading companies because of oil, which Brent is up at 78 or 79. So I think those companies are going to gain momentum going ahead.
But factoring in oil prices right now and political risks around geopolitics and further weakness of the Japanese yen, what does this really mean when it comes to that wage growth momentum that the new prime minister wants to see?
I mean, in terms of real wages, it's not going to be good. But if the Shunto wage negotiation spring wage negotiation result comes out stronger than last year, that's going to be a good momentum. But at the same time, I don't think investors are pricing in that much because last year's Shunto came out way too strong.
Yeah, we do have the labor cash earnings later in the week. When it comes to the economic package by the new prime minister himself, that he wants his cabinet to draw up, and some of the comments that we saw on prioritizing really overcoming deflation, what are you gauging in terms of the key things that investors should be watching for the rest of the year, especially towards the general elections at the end of the month?
I mean, we don't have much data to going ahead into the elections, but I think the monthly labor survey that will come out tomorrow, that's going to be very important. Whether or not real wages, in terms of same sampling, will come out positive in terms of scheduled earnings and, of course, headline as well. But I personally care about the real disposable income rather than the cash earnings because that's what people have in hand, right? And I think investors, when I talk to investors overseas or in Japan, not many people are focusing on the real disposable income, which I think is more important. Right?
They have that cash in hand, but the problem always with Japan is, will they let it go and actually spend, right?
Yes.
Some people that I've been speaking to headed towards the October 31st BOJ decision and the later ones in the year. We're thinking that we do have finally real wage growth for a few months, positive territory. But compared to the decades of stagnation that we've seen, that it would be way too soon for the BOJ to tighten too fast. What are your expectations for that pace?
So that's a very interesting point because if you recall Governor Ueda's comment a few months back, he was kind of dovish on consumption, but then he kind of flipped and he hiked, right?
Yeah.
So whether or not the real consumption is strong or not, I think the BOJ is seeking to hike in the near term, but I don't think the markets are pricing in hike this year. But possibly
it's been pushed out to January now.
Yeah, January. But even January, some people might be skeptical. But for me, I think it's January.
Why?
Because the BOJ will have a chance to hike without
waiting for the Shunto negotiations.
No, but you'll get the first kind of indication or a leading indicator or how much a broad general sense of Shunto is going to be.
Yeah, Suntory won 7% rate pay hike already for next year.
Yes.
Yeah. Shoki, Omori, it was really good to have you with us, of course, setting the week for us, Chief Japan Desk Strategist at Mizuho Securities, as we await those labor cash earnings later in the week as well. Catch Japan Ahead every Monday, 8:40 a.m. if you're watching in Tokyo, 7:40 p.m. Sunday in New York. And subscribers can watch live on the terminal using the TV Go function. This is Bloomberg.
Some of the latest corporate headlines that we're following this hour. Bloomberg has learned that Tencent and the founding family of Ubisoft are weighing options, including a potential buyout of the French video game developer. Sources say Tencent and the Guillemot family are speaking with advisors on how to stabilize Ubisoft after it lost more than half its market value this year. Ubisoft shares jumped 33% on Friday following that report. Rio Tinto has confirmed it's made an approach to acquire Arcadium Lithium. Rio says the approach was non-binding and there's no certainty any deal would be agreed upon. In a separate statement, Arcadium Lithium confirmed that it had been approached. As early as 3 months ago, Citigroup analysts suggested Rio should buy Arcadium, with the lithium miner trading well below replacement value.
And take a look at how we're setting up for the major market opens across Asia. We do have Australian markets away on holidays, but we could see a pop with Nikkei futures up about 3% right now. This, of course, after 2 sessions of gains already for Japanese equities. We had also the Japanese yen weakening for a 4th consecutive session against the U.S. dollar with around 2-month lows at this point. Of course, we've been watching some of the priorities by the incoming government of Shigeru Ishiba, really prioritizing overcoming deflation. He wants to keep raising wages, and U.S. futures at the moment not doing much after gains in the previous session. But this, of course, after already a 20% jump on the S&P 500 in 2024. This has added $8 trillion to the market cap. And of course, as we continue to watch Treasury yields surging after that jobs data, Haidi, very consequential as we, of course, have U.S. inflation numbers out as well this week.
And key to that inflation picture, Shery, is going to be obviously the outlook when it comes to broader energy markets and the rally that we've seen across other commodities as well, right? Largely on the back of this optimism over the China recovery. At the moment, we're actually seeing Brent crude sitting a little bit softer, about 0.7% lower. They're under $78 a barrel. That drop coming as traders continue to watch and wait for the Israeli response to the Iran strike. We've heard from President Biden discouraging attacks on Iranian oil fields and energy assets, but we have seen Israel ramping up hostilities over the weekend, both in Gaza and in Lebanon. That slipping in the Brent crude price after, of course, jumping the most since January 2023. Last week, WTI was near $74. So we continue to watch and see the picture when it comes to oil. Iron ore seeing a little bit of upside there, and copper also recouping some of the losses as we saw that stabilization after so much enthusiasm over the China stimulus story.
This is the Asia Trade. We're counting down to Asia's major market opens. As we head towards a busy week, Heidi, we do have central bank decisions across Asia. We just got, of course, the jobs growth numbers out of the U.S., the fastest pace in more than 6 months. What this really means for the Fed's trajectory and U.S. inflation numbers later in the week as well.
And what does it mean for the path of easing, Shery, right, when it comes to Asian central banks like the RBNZ, for example, this week for South Korea's economy and that monetary policy setting? And of course, we're kind of seeing this regrouping of what bond traders are thinking after yet another strong economic print from the US.
Yeah, with Treasury yields surging, we had the best week for the U.S. dollar in over 2 years. On the other side of that trade, we have the Japanese yen continuing to weaken in today's session as well. We're talking about lows that we haven't seen in around 2 months already against the greenback. So we're seeing that little bit of a gain in the Nikkei and the topics. Let's see how we're opening at we're expecting a little bit of a pop. There we go at the open. Gains of more than 1.5% early in the Asia session. Of course, we We already had 2 sessions of gains for Japanese stocks. We are watching for labor cash earnings later in the week. And of course, Prime Minister Shigeru Ishiba now outlining to his cabinet to really come up with that economic policy package in order to defeat deflation. Take a look at how Korea is also coming online, because we had the worst week for the Korean won in months. And right now we're seeing a little bit of strength early in the Asian session. Kospi and Kosdaq stocks gaining ground at the open. Of course, we'll continue to watch the likes of Samsung, where we do have their earnings later in the week as well, Heidi.
We also have a bit of an inflation reading when it comes to Australia. This is the Melbourne Institute inflation reading year on year for September, coming in at 2.6%. So a little bit of a quickening from the 2.5% in the previous reading. On a month-on-month basis, that is a gain of 0.1% following a slight contraction in the previous month. Of course, a lot of questions when it comes to Asian central banks that are very closely watching the trajectory of the Fed. The RBA, of course, has been sort of more on the back foot and definitely more on the hawkish side, and continuing that hawkish pause. But we're watching the likes of the RBNZ, for example, in terms of how they're going to price these Fed expectations potentially into how they move. Data, of course, show the fastest US jobs growth in 6 months. That was that surprising drop in unemployment, higher wages, and all of that, of course, feeding through to the surge in Treasury yields, and really the furious reversal, if you will, when it comes to these bets of another half-point rate cut from the Fed as soon as next month. In fact, if you take a look at where we're sitting now, we're sort of within reach of 4% on the 2-year yield, 150 when it comes to trading in dollar yen, on the back of a dollar strength, and now less than a full rate cut being priced in based on swaps market pricing for November 7th from the Fed. So there's a great deal of uncertainty. We're also seeing the other side of that trade as well. New Zealand bonds, for example, dropping along with Aussie futures early in this session after the topping of estimates from that US jobs number, Shery.
Heidi, let's bring in our next guest, who says some of the recent dislocations in Japan and India are providing opportunities. With us now is Vikas Pershad, Asian Equities Portfolio Manager at MNG Investments. Vikas, always great to have you with us. Tell us a little bit about the Japanese equity markets, because we're seeing this upside with a weaker Japanese yen, but at the same time, we know that smaller, domestically focused stocks might suffer. So do you sort of diverge in what you like in this market, or is it just all across the board?
Hi, good morning, Heidi and Shery. Well, always wonderful to be here. Japan remains a market full of cheap equities. The sell-off on the 5th of August was a gift for long-term investors, and we took advantage of that dislocation. 2 years ago, if somebody had told us that the yen would weaken through 150, 155, 160, one would have positioned or wanted to position heavily in Japanese exporters, but they actually underperformed. You had to be very stock specific. You had to do your homework. Even now, same thing is true. As the yen is weakening again and heading back to 150 perhaps, the inclination is to allocate more capital to exporters, but we see opportunities across sectors, across the entire market cap curve in Japan. And the longer your time horizon is, the better Japan looks.
How much do you factor in what the government wants to do? We are expecting that policy, an economic package coming from the new Prime Minister Shigeru Ishiba. We know that when it comes to investing in the U.S., India, China, for example, a lot of those favorites tend to be sectors that we know the government will back. Is that the case in Japan as well?
It is definitely the case in Japan. If we start with semiconductors and then expand into autos, we're seeing a lot of opportunities there. Companies that are going to benefit from government stimulus initiatives. Same for the consumer. Government stimulus is helping the consumer not just in China, but in India and in Japan as well. And we're looking at a lot of opportunities in those spaces.
Because we've got to talk about China. So much of the stimulus has been on the monetary policy side. Are you expecting more fiscal stimulus? What do you expect from the NDRC meeting tomorrow? And how do you, I guess, focus on the opportunities now that this market has really revived?
Well, I'll address the second part of that question first. We've been doing this long enough to remain humble and to not make too much of short-term moves. But as Fabiana, our CIO, and Dave Parrott, our head of Asia ex-Japan investing, and I have been saying all year long, Chinese equities have been cheap. If you look at the overall contribution to the global economy from China, and you look at the overall contribution of Chinese equities to aggregate market cap, there's been a huge dislocation. And so we're not surprised that There has been a rally in Chinese equities. We have added significant capital to China throughout the year, especially in the second half of the year. The timing is always difficult to predict, and the magnitude of a move is always difficult to predict. But our view has been that Chinese equities have been underpriced. We didn't time it. And we know that when markets open again tomorrow on the mainland, there's a possibility of a pullback, but our view is long-term. Now, in that context, the initiatives that come out tomorrow probably are continuing to support the consumer first, and then moving on to other industries as well.
So do you think there is a fundamental rebalancing of portfolios at the moment, and perhaps that is taking some of the interest out of markets, that have been market darlings, like India, for example, and including the likes of Japan?
Well, our view is that India, on a very long-term view, remains investable, remains inexpensive, especially in leaders across their fields. And this is on a multi-year horizon. If you look at a one-year forward multiple, optically, India seems pricey, perhaps even expensive to some. But you have to look at what that multiple becomes. Earnings growth is very high in India, especially in the capex-sensitive sectors, the industrial sectors, in real estate also. So there's a lot of growth to come there, auto ancillaries. But in a regional context, in a global context, our view has been that the underallocation to Chinese equities at the start of this year, at the start of the quarter even, is too low. And so in our India strategy, we're fully deployed. But in our Pan-Asia strategy, slightly underweight India, overweight China.
Because, of course, there will be great implications for these Asian markets and economies depending on where the U.S. economy goes from here, right? There were concerns and fears about a hard landing, but now it seems that the no landing at all scenario is back on the table given the stronger than expected labor market data. What are your thoughts?
Our view is that a recession in the U.S. had been possible. It is still possible. The question then is, what is the probability of that? In our view, that was low. Given the jobs report from Friday, that probability has become lower yet still. But as we incorporate into our portfolio, into our probabilistic thinking, into the comments that we've shared with you over the past few months, interest rates, FX rates, these are important. We're not ignorant of them. Geopolitics has been a greater area of our focus, not just on the single opportunities like investing in the defense sector all across Asia and in India in particular, but then also just factoring that into potential supply chain disruptions, risk premium that we apply across the region to markets and to equities. And so I would say that we're spending, as a team, more time thinking about what's happening in West Asia, what's happening in Eastern Europe, and what could happen in other parts of the world over the next few months and quarters.
Vikas, really great to have you with us. Vikas Pershad, who's the Asian Equities Portfolio Manager at M&G Investments. We do have some developments when it comes to what's going on with Pfizer. And in fact, the activist investor Starboard Value has taken a roughly $1 billion stake in Pfizer. This is according to reporting from the Wall Street Journal. They want the struggling drug maker to make changes to turn its performance around. This is according to people familiar with the matter. Remember, Pfizer had a market value of about $162 billion as of Friday, but those shares have been roughly cut in half from the record high that we saw in late 2021. Of course, that was on the back of the company delivering the world's first COVID-19 vaccine. They've been pretty unchanged this year compared with that broader 20% plus rise in the S&P 500. Starboard has approached two former Pfizer executives, Ian Reid and Frank D'Amelio, to aid in these efforts. They have expressed interest, in helping there. So some of those other specifics could not be learnt at this point, but certainly Pfizer and the current CEO, Albert Bourla, has been under increasing pressure from investors to right the ship at the drug maker. It overestimated future demand for pandemic-related products once, of course, we saw the pandemic really become less of a public health priority. Shery.
Heidi, we're also watching game stocks early in the Asian session. This on local news here reporting that Saudi Arabia's sovereign wealth fund is considering increasing its stake in Nintendo and other Japanese game companies. That's according to Kyodo, citing an interview with Prince Faisal bin Bandar, vice chairman of the fund's subsidiary Savvy Games Group. Although the public investment fund isn't in a hurry and wants to make sure game companies agreed with any investment by the wealth fund, he was quoted as saying that they're considering increasing their stake in Nintendo and other game stocks. Nintendo at the moment seeing its best day in over a week. We have more ahead on the Asia trade. This is Bloomberg.
The Israelis have not concluded what they're going to do in terms of the strike. That's under discussion. I think if I were in their shoes, I'd be thinking about other alternatives than striking oil fields.
President Biden there speaking to reporters on Friday. As Israel marks a year since the October 7 attacks by Hamas, it's locked into a multi-front war with no clear end. Prime Minister Benjamin Netanyahu is still weighing on how to respond to Iran, which launched a salvo of almost 200 ballistic missiles at the Jewish state last week. Our Bloomberg News desk editor Jill Desis joins us for the latest. So do we have any hints as to what Israel's response might be at this point?
At this point, Heidi, we're still waiting to see what form this retaliatory strike ultimately takes. As of right now, we've seen, some offensive attacks in northern Gaza. Israel has just launched overnight an aerial and ground attack there, issued the largest evacuation order that we've seen in months in the year since this conflict really took off last October 7th. The local authorities there are reporting 26 casualties. Aside from that, Israel has also launched, some additional attacks in Lebanon, targeting Hezbollah-backed forces there. But this broader picture, this idea of what might Israel ultimately do with respect to Iran, we're still not sure. As you just heard Joe Biden, the U.S. president, say there, the U.S. has been attempting to deter Israel or discourage Israel from striking oil or nuclear facilities. That would be more of the extreme scenario here in favor of something else. Also on the table, potentially Israel could target military operations within Iran. But at this point, it's still not entirely clear what Israel's response is going to be and how significant that may be here.
Now, a year after the Hamas attack on Israel and these renewed Israeli strikes in Gaza and much of the territory already being in rubble, what does this really tell you about the complexity of eradicating this militant group?
Yeah, that's right, Shery. So, look, this has obviously been an incredibly intense operation. I mean, there are still thought to be somewhere around 100 or so hostages being held in Gaza in the year since, those initial attacks took place October 7th. It's been very difficult from Israel's perspective to actually, cripple a lot of these Hamas-led operations. We've certainly seen, potentially more success with how Israel has crippled some operations for Hezbollah, Iran-backed militia in Lebanon. But obviously in Gaza, it's a bit of a different story here. These latest attacks that we've just been speaking about here were said to have targeted some communication centers, some facilities there. But obviously Hamas still retains some significant operations within Gaza.
Given that we're about a month away or so from the U.S. elections, what can we really gauge when it comes to the Washington response in the Middle East?
Well, this has been a really politically fraught time for Washington, trying to work with Israel, its ally, on trying to calm tensions within the Middle East. The most recent strikes that we've seen, including those on Hezbollah, it appeared the Joe Biden administration was kind of in the dark for a large percentage of that. So at this point, you just heard Biden talk about the desire by the U.S. to discourage Israel from escalating this to the point where they're attacking energy facilities, nuclear oil facilities. It doesn't really, though, appear that the U.S. has over the past year been able to really kind of temp down, some of these operations by Israel, and this conflict has just continued to unfold. Whether the U.S. or any of its other allies might be able to be successful in deterring Israel from escalating this into even broader conflict, I think that's still a very open question right now.
Bloomberg News desk editor Jill Deese is there with the latest on all of the tensions in the Middle East as we continue to watch oil prices opening lower in the week. This, of course, as we're still awaiting the Israel response when it comes to Iran and how they will retaliate against that missile attack last week. But really, suffice it to say that we've seen a lot of moves and a lot of volatility in the oil space. When it comes to those bets on oil prices, they're the most bullish in 2 years. Of course, last week we already saw the largest gain in more than a year, a jump since the start of October when Iran launched those strikes on Israel. And we'll have more analysis on the energy sector with Vectis Energy Partners Tamar Esner later in the show. But in the meantime, take a look at how we're trading in Japanese assets as well, because JGB yields now are surging and following Treasury yields higher. Of course, we did have that stronger than expected jobs numbers out of the U.S. We are headed towards inflation numbers out of the U.S. this week. Not to mention, here in Japan, we also have labor cash earnings coming out on Tuesday to get us an indication of where wage growth is going. With really yields in the 10-year JGB yield at the highest level in a month, we're seeing the Topix Bank Index also gain ground. We're talking about the strongest levels in more than a week. We have more ahead on the Asia trade. This is Bloomberg. China's economic planner will host a news conference tomorrow to discuss the implementation of incremental economic policies. This comes as the world-beating rally in Chinese stocks is failing to convince some global fund managers and strategists. For more, let's bring in our China correspondent Min Min Lo. And Min Min, of course, there's really been a lot of skepticism about this Chinese rally, but what can we really expect from the NDRC tomorrow that could boost confidence?
Yeah, hard to say what we could expect tomorrow, but obviously we'll be looking out for whether there will be fiscal measures to boost consumption, to boost employment and income, as well as social security benefits, for example. We also want to look out for any measures to support private sector growth and investment, and also look out for the tone that officials take here and how much supply side versus demand side policies there would be. And another thing to look out for is also whether the NDRC officials will announce the widening of the usage of local government special bonds to other projects, such as buying back unsold homes, for instance, because NDRC is in charge of approving the projects that these bonds are used for. And this comes as we have seen this huge rally in the Chinese and Hong Kong stock markets. The Chinese markets reopen tomorrow. There is a lot of expectation that it will jump by quite a wide margin in a catch-up rally. But of course, there are many global fund managers that are also quite skeptical about how long this rally could last without a fundamental improvement in the economy.
In the meantime, the EU has voted to impose up to 45% tariffs on Chinese EVs. So what do we expect to see next?
Yeah, so these tariffs will kick in starting from November and will last for 5 years. But we know both the EU and China have agreed to continue to keep negotiations going. And Volkswagen's CEO, for instance, have said that he is fearing retaliation from China that would obviously hit these German car makers very badly. It could significantly disadvantage these car makers in their China sales. And he is suggesting that some exemptions be given to Chinese companies that make investment into Europe to open up plants there. And we know companies like BYD and Chery, for instance, are looking to open up plants in places like Spain, Turkey, Hungary, for instance. So the next stage of this EU tariff war, if you will, could be perhaps focused on these plants. The EU may turn their scrutiny towards these factories and whether they are actually bringing in more jobs, more investments and more technology to Europe, whether they would stipulate some sort of local content requirement to prevent China from just bringing these knockdown kits only to have most of the content made in China only to be assembled in the EU. And of course, there's also the fear of broader retaliation from China that could hit other sectors such as European agricultural produce, for instance.
Bloomberg's China correspondent Min Min Lo there. So we will be watching some of these automakers as futures markets, I should say, open up. Take a look at how futures are trading in Europe at the moment. Stoxx 50 futures and German DAX futures are looking like this. We did see quite a bit of optimism in that Friday session after that surprisingly strong report on US employment, really encouraging investors that the economy is just fine. This idea of a no landing scenario, right? But of course, a lot of questions as to whether this really limits the Fed's ability to ease meaningfully further over the next few meetings, we're seeing futures looking pretty positive across the board. And Shery, we are sort of watching, broader markets in this world of really monetary policy uncertainty.
Yeah, I mean, we could get some big news coming from FTSE Russell, right? Especially when it comes to those sovereign bond inclusions into their benchmarks, including the World Government Bond Index. And right now, one of their top contenders, South Korea, I mean, they were put up for inclusion about 2 years ago. They've made a lot of changes, including really extending their trading hours for the Korean won. They haven't made the cut yet, but the government expects that if they do, in fact, succeed in getting on the WGBI, that they could draw as much as $68 billion of inflows, and really important for the South Korean economy at this point to get some fresh funds, right? Especially given that it suffers from one of those key issues in these developed economies, aging societies.
Yeah, we're also watching Indian bond markets along sort of the same vein when it comes to this revamp, right? They joined the flagship JP Morgan Chase gauge despite being seen as kind of a reform laggard. They could get into FTSE Russell's EM bond index this time around. The provider told investors it had very positive meetings with India's securities regulator, according to a document seen by Bloomberg. So it is interesting timing to get access to the big investors attracted by, this sort of status to get into that emerging markets index, right? Particularly as US borrowing costs come down. India's JP Morgan index bonds, eligible bonds, I should say, have attracted about $14 billion of inflows this year through to the end of August. Shery.
Yeah, take a look at how treasuries are pricing in right now, potential Fed easing. Really, a lot of changes when it comes to these bond traders and that pricing in of more rate cuts to come, because right now, swap traders now seeing 24 basis points of easing at this point for the month of November, which is really being dialed back, right? I mean, we had seen much more aggressive cuts being priced in. Even that outsized 50 basis point cut now seems to be out the window, especially after those more solid labor market data points. Of course, the latest one was the payrolls numbers, U.S. job growth at the fastest in 6 months, even the unemployment rate unexpectedly declining. And remember, last week we also had ADP private payroll surprising to the upside. We also had U.S. job openings rising to a 3-month high. So right now, the concern is that perhaps it's not about a hard landing, it's about a no landing scenario at all, where the U.S. economy keeps growing, inflation gets reignited, and the Fed has, of course, little room to cut interest rates. And, of course, what this really means, Heidi, for central banks across Asia, we get the BOK, the RBNZ, and the RBI also deciding on rates this week.
Yes, all of which, no doubt, watching the Fed very closely. But take a look at how we're trading so far this Monday. Of course, here in Australia, New South Wales is seeing that Labor Day holiday, which means no trading when it comes to Aussie stocks. But take a look at the broader picture. We are seeing that rise across markets there on account of perhaps that yen story. We're seeing Japanese stocks up by almost 2% when it comes to trading on the Nikkei 225. We have the Kospi also up by about 0.25% there. The jobs report really kind of boosting sentiment. Oil, though, dropping, so we'll watch for some of those oil traders as they come online throughout the course of the day, and of course watching this week for that China reopen, whether those gains can be sustained. More ahead. This is Bloomberg. Take a look at oil markets. We're opening the week lower there as we continue to watch and see if Israel retaliates against Tehran for that missile attack and in what form that takes place. And we heard, of course, President Biden discouraging a strike on oil assets. We're seeing iron ore looking a little bit more optimistic. We do have that NDRC meeting tomorrow as China markets reopen. Let's bring in Tamar Asner, who's a principal at Vectors Energy Partners. Tamar, really great to have you with us. So I guess give us your assessment of how much the situation and the uncertainty in the Middle East is really weighing and whether that changes market fundamentals at this point.
Yeah, so we saw a big price spike last week on the headlines that potentially Israel was considering targeting some Iranian oil assets, and oil prices spiked. I think that was a lot of short covering, and I think that the ultimate narrative that we've seen in the market since this initial war began just last year is that basically unless there's a sustained outage in oil production or oil transit, the market's basically going to continue to fade geopolitical risks. So obviously the risks are going up, and so that should sort of shore up oil prices. But I don't know that recent spikes are going to be sustained unless there really is that outage. And we think that even though the tensions are definitely getting hotter, I don't know that it's in necessarily Israel's interest or Iran's interest to see oil directly affected.
Does the China reflation story play a meaningful role at this point?
We're waiting to see whether that gets translated into actual increases in Chinese oil demand. It was interesting to see that Saudi actually raised their official selling price to Asia, specifically for China, and lowered it in other parts of the world. I think that was partially to get ahead of that issue. Also, there is the idea that China has really been a swing producer, so they've been swing consumer, so they've been actively buying for their large strategic inventory. So as oil prices have moved lower, that's been a real opportunity for them to add. And I think Saudi wants to sort of get ahead of that issue and avoid that. So I think that is part of the factor, but the market's so bearish now on China that we need to see it play out in the actual data.
Is that why OPEC Plus is also holding off in bringing more barrels to the supply markets? And what does that mean when it comes to the supply-demand balance?
Yeah, the OPEC situation has been a huge overhang on the market, and one of the biggest reasons that oil prices are not higher in spite of all of these geopolitical concerns. They've obviously, the cartel has telegraphed that they want to add more barrels back, but there really isn't enough demand for it. I think that they're waiting until the December meeting. They obviously want to see how things play out between Iran and Israel and see if there is room for them to add more barrels. But clearly the market doesn't need these barrels. And honestly, the risk is really for much more material downside because of ultimately the risk for a market share war. I don't think that will ultimately happen, but the risk is still there, particularly when you look at the tensions between Saudi and Iraq, because Iraq has been one of the bigger overproducers. They've gone outside their quota, and we know specifically that UAE in particular wants to be adding more barrels. So it's a real question for the market, and one of the main reasons that oil prices aren't higher at this time.
Although we're really not sure how this will develop in terms of the Iran-Israel conflict, given that there are conflicts on multiple fronts at this point, what's the wild card in the Middle East, and how important would be that we keep a close eye on what happens in the Strait of Hormuz?
Well, that's, I think, the mother of all issues. Obviously, we also would want to keep the issue contained between Iran and Israel. If, Saudi starts to get involved or other regional powers, then, all bets are off, and we could be talking about materially higher prices until the conflict is resolved. But certainly when you look at the Houthis in Yemen, they're a wild card because they're tremendously ambitious, and it's questionable just how much control Iran has over them. So I think Iran is sort of trying to keep things telegraphed. Keep things contained. They're obviously in a very weak position. To the extent that Israel goes after oil assets in Iran, I think it would be more on the domestic refining side. So I don't know that would have much of an impact on the global oil markets. I think Israel is not really incentivized to go after the oil production and the oil exports because they have enough enemies right now. And I think that would create more enemies for them globally. I think that they will go after targets in Iran itself that will actually increase Israel's security in the near term, whether it's weapons or weapons deployment systems and manufacturing systems. But to the extent that Iran or the Houthis in particular feel really emboldened, they could attack. We've seen it before. 2019, they attacked Saudi oil processing facilities. And really, the moral of that story was the market bounced pretty quickly. So there was a short-term spike, and there was enough redundancy in the system, and the oil price spike was not sustained. So that's something that market participants are also remembering.
Could we see more pressure, though, coming from seasonal demand as well, given that we're headed towards winter in the northern hemisphere, and of course there will be more heating needs?
Yes, absolutely. Unfortunately, as we head toward the end of the year and into the new year, there's even more production coming online from non-OPEC producers. So that's a big part of the problem. The other near-term part of the problem is that as summer is coming to an end in the Middle East, there's less power demand for oil in the Middle East. And so there's extra barrels from OPEC that's technically within their allotted barrels for compliance reasons that potentially OPEC countries could be exporting. So that's a sort of overhang in the market right now in the context of demand being soft. So that's another seasonal factor that we're not really sure how to play into, because to some extent it makes some more argument for an oil price war, even though it's a temporary factor with those barrels no longer being used for power burn.
Tamar Esner, principal at Vectis Energy Partners. Always great to have you with us. We have more ahead on the Asia trade. This is Bloomberg.
Enough talk about inflation is dead. Inflation is not dead. Enough talk about the Fed should only be concerned about maximum employment. It should still be concerned about its dual mandate.
This is, across the board, a very strong report. If you look in the under components, retail, professional services, education and health services, all significantly beat above their 3-month running average.
I think the Fed should still go another couple of 25s. And then I still think they should go next year. And I don't think you're going to create any instigant for more inflation here. I just think the rate's still too high.
We've been saying slowing but not crashing, and I think certainly the markets and the Fed were very focused on potential downside risks as a result of the weaker labor market reports.
Some of our guests weighing the Fed's next move after the stronger than expected U.S. jobs report. Let's get to some market calls we're following today. Billionaire investor Stanley Druckenmiller is concerned that the Fed has boxed itself into a corner when it comes to future interest rate cuts. Druckenmiller hopes the Fed is not trapped by forward guidance the way they were in 2021. He explains growth is above trend, corporate profits are strong, stocks at an all-time high, and credit is very tight. Druckenmiller's comments were built on warnings by other Wall Street figures that markets need to temper expectations about the pace and extent of the Fed's easing. For Wall Street veteran Ed Yardeni, the Fed may hold off on rate cuts for the rest of the year following the strong jobs report. The founder of Yardeni Research says further policy easing would risk sparking inflation just as oil prices rebound and China seeks to jumpstart its economy. He adds that the central bank's September decision to lower rates by 0.5 percentage point was not necessary. Heidi.
Take a look at how Asian markets are trading, Shery, as we really continue to be wait and see on a lot of things, right, including how the Fed's trajectory may be informed by just a steady stream of strong macro data, of course, culminating in those jobs numbers, what that means for perhaps the refocusing of that dual mandate. We are seeing the Nikkei 225 extending those gains up now by 2.25% on the back of the moves that we've seen in the yen. The Kospi is also seeing a little bit more upside, about 0.5% higher, and trading here, despite, of course, being a public holiday in New South Wales, so volumes would be pretty thin, but a bit of upside there for Aussie stocks as well. Well, China's latest stimulus package has boosted investor sentiment, with the MSCI China index now catching up with the S&P 500. Our Bloomberg Opinion Columnist Shery ran says global asset managers now need to decide whether Chinese stocks are on the cusp of a re-rating. Shery's with us now. So, it's difficult, right? Because we continue to ask this question of whether this is a false dawn, another false dawn. What should asset managers do at this point?
Well, it's very difficult for them because they have already missed the initial stage of the rally. This rally is basically vertical. So on the one hand, Chinese stocks are still not expensive, though, because Chinese stocks have become so cheap. Even after all this rally, the MSCI China index is trading at 11.4 times forward earnings. That's lower than than when China exited COVID zero about 2 years ago. But on the other hand, we have seen quite a few episodes of that cat bounce, right? Like early in the spring, people were thinking, oh, China's bear market was so extreme that the Beijing just has to come out with stock stabilization fund, and that didn't pan out. After the COVID zero exit, people were hoping that China will have a reopening trade, and that didn't pan out either. So it's very difficult for global investors. And also they're not as well informed as domestic investors, right? By the time they figure out what's happening in mainland China, what the market expectation there is, that market has already moved up or down by 30%. So it is a very difficult situation they are being put in.
Yeah, I mean, visibility is so low, whether it's the markets in China or just government policies as well. When it comes to the world of investing, broadly speaking, what impact is China having at this point?
I think China has pretty much become a 0-1 coin toss. It's so policy driven. Like people were saying, oh, how can this stock market be gaining 30% in 4 days? Actually, it's not surprising. That's just what China is going to become going forward. And I think in a lot of ways, it's very difficult for investors because a lot of them were trained to study economics, to study finance. They do fundamental research, et cetera, et cetera. But these days, politics, knowing politics and having political connections matter more than your finance skills. And I think it's not just China. I mean, in the U.S., we hear President Joe Biden off-cuff remark, it can move the oil market. In Japan as well, Japanese politicians, who is going to be the next prime minister and what his view is on the Bank of Japan's easing policies. All these geopolitical events, they're really changing the world of investing.
It's, as you say, about reading into whether this is a pivotal moment for the Communist Party and their ability to stage a turnaround, or whether this is sort of just, another dead cat bounce. So to that extent, what would you be looking for in terms of what we hear, what we see from policymakers?
I think, unfortunately, we're now going to see very concrete measures. I'm not having such high expectations on the NDRC's press release tomorrow. So what we need to hear is the rhetoric. If it's really the Chinese version of whatever it takes moment, that kind of rhetoric. Because if you want to see concrete, whatever, like 1 trillion, 2 trillion, this number, that number, it's not going to come out that quickly. But we do need to view the rhetoric and see if the top policymakers' pain point has been reached.
Bloomberg Opinion Columnist Shery ran, of course, as we look at the Chinese economy and we prep for that market reopen after Golden Week tomorrow. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at Taiwan futures at the start of this week. We are seeing broad optimism really across major risk assets as we see the buoyancy really of those US jobs numbers as broadly boosting sentiment, even if it does sort of add an element of further confusion as to what the Fed will do from here. That no landing scenario is really coming into play here. Taiwan futures up by about 1.5%. We're watching Hon Hai and some of the iPhone related stocks and tech in particular as they saw that sustained revenue rebound with some help from AI. The third quarter sales, according to Hon Hai, is a record for the period. Those companies' shares have increased more than 85% this year. We're also seeing broader TAIEX futures as well as the FTSE Taiwan Index there, all seeing some upside. Let's get some more on when it comes to Foxconn, or formerly known as Hon Hai. And as I just mentioned, we had those pretty robust third quarter earnings over the weekend. Our tech reporter Annabelle Jewellers is in Taiwan and joins us now for more. And Belle, what sort of stood out to you in these numbers?
Well, I think it's certainly that big focus that we're seeing for Hon Hai just generally on the AI server business, because it's really been what is becoming the key future growth driver for the company, especially as we see sales of consumer electronics start to slow. But the focus on AI servers in particular, Hon Hai had previously highlighted back in August that it was going to continue to be a growth driver through the end of the year. Our Bloomberg intelligence team saying into 2025 as well for the company. But this really stood out in these numbers because in the third quarter, we actually saw revenue coming in at $60 billion. That was ahead of what analysts had been expecting, and you could actually put it down in large part to the growth of the AI business. In particular, as we said, those servers using NVIDIA chips made by TSMC going into the likes of Alphabet, Amazon, Microsoft to scale up their AI clouds.
What about the smartphone segment itself?
Yeah, as we said, that sort of growth around consumer electronics is slowing, and so this has certainly been something that has been impacting Hon Hai in particular. It's known, of course, as the world's biggest assembler of iPhones. It doesn't just make iPhones, it makes many other electronics, the Google Pixel devices, for instance, Ring doorbells, the Kindle, Nintendo Switch, PlayStations, lots of different types in the mix of its products. But as we said, slowing. We have seen sales of iPhone 16, those early indications telling us it's not going to be quite as good as had been expected. Concerns around the sort of AI component of the iPhone in particular, sort of underwhelming market expectations. So that's one factor that plays into the figures. And then there's the other factor as well that Hon Hai and many Taiwanese assemblers in this market have left, just given how much pressure's on the margins. It is sort of facing increasing competition, particularly from Chinese competitors. Luxshare is one of those that's increasing its share in the market as well. So something else that is a headwind, I guess, facing Hon Hai in this segment in particular.
And you're obviously in Taipei to cover the tech day from Hon Hai this week. What are we expecting?
Yeah, this is a really major event for the company. It's the 5th time that they're hosting a tech day, and we're at the venue yesterday here in Taipei, just having a look at the sort of size and scope of it. It's going to be a really major event for the company, celebrating or marking its 50th year since founding. It's the first time as well that it's going to be open to the public, so it just tells you again that level of interest we're seeing in companies like Hon Hai, which we should just note shares are up more than 80% year to date. But the big focus at this event is going to come down to the EVs in particular. This is, again, what Hon Hai is sort of pinning as a possible growth driver for the company moving into the future, their contract manufacturing service. We haven't really seen any big customer announcements just yet, but it's certainly a big focus of one of the major interviews we've got coming up, which is with Jun Seki. He's the head of the EV division in particular, hearing more about their ambitions in this space. So certainly a lot of big names we'll be speaking with tomorrow.
Annabelle Jewelers there joining us from Taipei. And staying with tech and that focus on artificial intelligence, Khosla Ventures founder Vikas says AI is the most important tool in human history for creating abundance and a fairer, more equitable society. He told us more about his recent investment in OpenAI.
It's the most important tool we've had in human history for creating abundance and creating a fairer, more equitable, more well-off society. The company that wins in AI will lead this race. I suspect more than one player will be participating, so it's not just OpenAI, but I'm very, very bullish. OpenAI is executing extremely well on product, which is what matters, and on revenue growth. So I'm excited for OpenAI as being a leader, but probably one of the leaders in this space.
To be a leader, do you think Sam should take equity himself in the company?
That's for the board to decide. I do think Sam deserves something for what he's done, but it's not his highest priority. It's far from his highest priority.
Vinod, what is your assessment so far of Sarah Fryer? My understanding, speaking to some of your peers and colleagues in industry, is that she prepared a pretty straightforward presentation that tried to educate those that didn't have as clear an understanding of the path forward and business model. And actually, a lot of investors got it. They looked at the presentation and went, OK, we're on board with this. What was your reaction to her and to that?
Well, I've known Sarah for a long time. I was on the board of Square, now Block, when she was CFO there. So I've had a long relationship with Sarah. You're exactly right. She prepared a crisp presentation. It was simple, straightforward, said, here's where we are today. Here's where we expect to be a year from now. Much more than that is not that predictable. And it was compelling. Obviously, it was compelling to me. Otherwise, we wouldn't have invested.
Fair. And what's interesting is you say, look, it won't be the only one, but you want it to be the leading player. There was some consternation, Vinod, that within the documentation, there was a push that anyone who backs OpenAI can't back its competitors in the future. Is that normal? Is that something that you want to see in such documents?
You know, in very large bets, this is pretty normal. And it isn't a requirement. It's not a legal commitment. It's a mutual understanding, and we operate a lot on trust. So investors committed to get behind OpenAI and not its competitors. And that's pretty normal.
Khosla Ventures founder Vinod Khosla there speaking with our colleagues Hon Hai and Ed Ludlow. We'll take a look at how we're trading this Monday morning, and of course pretty thin in liquidity when it comes to trading in Australia. It is a Labour Day holiday here in New South Wales, but we are seeing broad upside really across regional markets there. The Nikkei 225 up by over 2%. We're seeing the topics also extending some of the gains there as well. Some of that is obviously the yen story, but we are really seeing that sort of no landing scenario after the upside job surprise from the US. So some of that economic resilience story is really playing through across the sort of optimism that we're seeing across risk assets at this point in time. Also watching some of those tech stocks given the resilient numbers that we had out of the iPhone maker Hon Hai with that sustained revenue rebound and some of the optimistic themes over AI as well. Watching oil where prices are trending lower as we continue to wait and see these further developments in terms of what that Israeli reprisal would be as we come up to the 1 year marking of the events of October 7th. Shery.
But definitely we're seeing those inflation expectations continuing to rise, given, of course, the risks around oil prices and, of course, as you mentioned, the jobs data out of the U.S. as well, right? And that's really being felt across yields right now. Treasury yields continue to rise after that stronger than expected jobs data. The 10-year break-even rate actually at a 2-month high. And JGB yields also following Treasuries higher. We're talking about the 10-year yield now at the highest level in a month. That's it from the Asia Trade. Our markets coverage continues. The China show is next. This is Bloomberg.